I only specialize in what I call the really great bubbles. If you go back to 1929 to 2000, to Japan and the housing part of the housing bubble, and you ask, how did conditions look? Profit margins looked great. The forecast was great. There was no chance of a recession. A few months ago, smart people were saying there was a 20% chance of a recession in 3 years. It is quite amazing. And what happens after the bubbles break is there's always a recession pretty quickly. People never get it. People never forecast it. And along with the recession comes a drop in profit margins. Going into the bubbles breaking, profit margins are always at a peak. Bubbles don't peak for no reason. They peak because economic conditions are nearly perfect. And that includes low inflation and high profit margin. And the first thing to go in a recession, of course, is the profit margin. That is very likely to happen this time. We should be in a recession, mild or severe is the question, but we should be in some sort of recession fairly quickly, and profit margins from a real peak have a long way that they can decline. And if you want to get into the longer term, I think this kind of 2000 bubble that we have is dangerously likely to morph into the 1970s, where inflation is always a part of the background discussion and where growth rate starts to dwindle away. So you have shades of stagflation as we had in the 70s, where commodities are intermittently scarce, price jags here and there, as we have seen recently, where the whole system is so strung out and so borrowed that it's lost its resilience. All you have to do is cough in COVID or a war in the Ukraine, and you see the problems ricocheting around the system that was not designed to absorb any kind of punch. Last minute inventory delivery, no reserves, putting all of your business with one country far away, no flexibility, no resilience. And now we begin to pay the price.
The beauty about indexing is you never miss an Amazon or an Apple. And the bad thing about indexing is you never miss having a lot of overpriced stocks into one of the relatively rare bubbles, such as we have now. So it's kind of good news, bad news. If you can ride out the odd 50% decline, totally unnecessary, of course, on fundamentals 30 years ago. The market is mildly hysterical from time to time, and it's totally unjustified by the steady stream of dividends and earnings. But it happens. And if you want to ride those 50% drops, good luck. It works out very well in the long, long run. But it can take you 20 years to get back in the game. If you get caught in 1929, it works out just fine, but you don't get your money back until 1955. If you get hammered in 74, you don't get your money back until 87. And then when you've gotten it back for a month or two, you give it up again. And the same in 2000. By 2010, you're still losing money. So you have to be willing to ride out. And some people feel their lives aren't long enough to take the 10, 15, 20-year wipeout. So for those who feel they're brave enough and willing to try, I've always thought that sidestepping some of the pain might be a good idea. I think they're perfectly straightforward. They're intellectually easy and psychologically disastrously difficult. They're easy because in most cases, they're so extreme. It's like, how do you notice the Himalayas when you're standing in northern India? I mean, they come out of the plane and they soar up. You can't miss these things. 1928, 29 was just such a massive rally. So the sheer price rise, you can't miss. Secondly, just to make it easier, the great bubbles have always tended to rise faster and faster towards the end. And that's a kind of defining feature also. And then thirdly, they have all been accompanied by massive, public, obvious, crazy behavior, where the headlines migrate from the financial page to the front page, where they migrate to the opening few sentences of the evening news on the radio or the television. And they talk about market new highs, and they talk about what the Bitcoins of the era have done. I know it's not a stock, but it's a speculative instrument, and the GameStops of the world. And back in 2000, most of you will be old enough to remember the pet.coms and the utter craziness of that period. And the same was true of 1929. The same was true of Japan. We had a group from Salomon Brothers, a leading American brokerage house of the era, who came around in 88, 89, when Japan was moving to 60 times earnings, and explaining that their yields, et cetera, and their interest rates, et cetera, they really should have been selling at 100 times, and they were cheap, and you should buy them. And it didn't stop the Japanese market breaking the following year. it has not recovered the high of 31 years ago yet. So that was pretty painful.